ETFs, they are the best investment, especially for your retirement. So it's always recommended that you hold it for 10 years or more. However, you may still be able to make a return on 5 years. Generally, it's a 10% compound interest year over year. I think that right now is probably the best time to start getting into ETFs. All right, so ETF number one I'm going to talk about is VTI. Now, this is a very common ETF. It has a risk score of 4, and I think that it's one of the best ETFs to have in your portfolio for your retirement or maybe a savings account. Definitely best to put money into your retirement every single month or every single pay. Now, this is not financial advice, so when I say you, I'm just talking to myself, okay? So take it as that, not advising anyone to do anything. All right, so in 2012, if you put $10,000 into VTI, today it would be worth $36,885. You would have made $26,800 over a 10-year period, which is pretty good. Now, if it was before the crash, it would be at $42,000. So just think 10 more years from now, it could be a lot more than what it is. And VTI has an expense ratio of 0.03. That's like $3 for every $10,000 you invest. So it is $206 a share about, and it doesn't really matter about how much the shares cost. It's about the yearly performance. It's all about the annual return, not the price of the ETF. VTI is also the total stock market ETF. It's pretty much the United States stock market. It has over 4,000 stocks or assets in the ETF. It's a basket of stocks. Number 2 is VOOG, and it's a top 500 companies by market cap. That's why people just invest in it, because it's the best companies, and normally the best companies do good year over year. Now, if you would have invested in VOOG 10 years ago, $10,000 into VOOG, today it would be worth $38,242. So it's actually down a little bit more than VTI. It has a 0.03% expense ratio for VOOG, which is the same as VTI. So number 3 is VT. So it's like, I would say it has less risk than VOOG and VTI, and I think it could have some upside. However, if you did invest 10 years ago, it'd be worth $27,155. So about $10,000 less than VTI. The reason is because VT is 40% international and 60% US stock. So VT is like a VTI and VXUS combined, but 60% VTI, 40% VXUS. VXUS is an international ETF. It has more exposure to the whole world, which is why VT is the total world stock market ETF. All the companies in the world, it has like almost 10,000 companies in this ETF. So it's a pretty good ETF. I wouldn't put all my money into it, because I would bet more on the US stock market. Now, VTI is one of my favorite ETFs. If you don't want 60-40, you could put like 80% VTI and then 20% VXUS if you wanted some exposure to international, which I think is good to do. I think it's good to have exposure. Number 4, VGT. Okay, now we're getting into some growth. Okay, so VGT is Information Technology ETF. This is the tech ETF, and it has a bunch of tech stocks in it. It has a 0.1% expense ratio, which is like $10 for every $10,000 you invest. It has a risk of 5, and if you see VT, it has a risk of 4. So 5 just means 10 years or more, and a 4 is also 10 years or more, but 5 is a little more risky. However, which means it has a lot more upside to it. So if you would have invested $10,000 into it in 2012, 10 years ago, today it would be worth $60,000. That is a lot more than the other ETFs. I personally think that right now is probably one of the best times to get into it, because it is down a lot. At year to date, if you go back to the end of 2021, it'd be up more towards $71,000 than 60,000. It's down 20% year to date. So it's down $100 from its high of 467. I started putting money into VGT because of how low it went down. Now, I'm not saying that the stock market's going to recover anytime soon. I think that it could fall a lot more, but it's always good to just dollar cost average into an ETF for your retirement. Now, if you want to take more risk, you can go more into VGT and you could possibly make a crap ton of money. This is like a almost guaranteed return. And then there is VOOG, which is the S&P 500 growth ETF, and it's a 0.1% expense ratio like VGT. How many holdings does it have? It says that VOOG has 243 holdings, and 50% of the holdings is in the top 10 companies on the portfolio. So these are all the growth companies in the S&P 500. They pretty much took out all the companies that aren't growth, and then they kept all the growth companies that were in the S&P 500. So you could possibly have much bigger returns. So let's see how the returns have gone. All right, so 10 years ago, $10,000. Today it'd be worth $42,000, which is a lot more than what VOO would be worth, just the regular S&P 500. Not much more, but more. Honestly, it's a lot more risky, but hey, you never know. And then VUG, which is the Vanguard Growth ETF. It's another growth ETF. So 10,000 10 years ago. Today it'd be worth 41,000. So I mean, there are a lot of growth ETFs out there. Now VUG has a 0.04 expense ratio, which is about $4 for every $10,000 you invest. VUG has about 269 holdings. Okay, and then there's MGK, which is a Vanguard Mega Cap Growth ETF. I never really looked too deep into this one, but I wanted to see a growth ETF. I don't know how good it runs, but it's a 0.07 expense ratio, which is $7 for every $10,000 you invest. But if you put $10,000 in, 10 years ago, it'd be worth $43,000. According to Fidelity, it has 111 holdings. So MGK is pretty good. It did pretty well over time. And then there is the last ETF, which is Vanguard High Dividend Yield ETF. All right, so if you invested in this ETF 10 years ago with $10,000, today your $10,000 would be worth $32,943, and that's still higher than VT, even though it's a high dividend yield ETF. Okay, so this ETF will pay you 2.72% dividend yield if you have this ETF for every share. Let's look more deep into that. So according to stockanalyst.com, the annual dividend is $3.10. So every quarter you get paid for this dividend, which is about 60 to 90 cents every single quarter for every share you own. So if you got $3.10 for every share and you owned 100 shares, you get $310 every year. Now, if you had $1 million, you could buy 10,000 shares and then you would actually have an income of $30,000 a year, which is pretty good. And if it actually goes up over the next 10 years, not only will you get the dividends, but the ETF will go up in price as well. So you'll also get the gains off of the ETF going up. VTI also pays a dividend. It pays $2.97 every quarter, but it is $200 a share. But you'll also get more gains instead of dividends. You know, it all balances out. Now, I personally think that VGT is a super good one to invest in. That's what I'm going to be putting money into in VTI for right now. I don't really care much about VOO because I also want exposure to the other stocks in the US stock market, not just the top 500 companies. I want to get more in depth into certain ETFs that you can invest in, not financial advice, but like go more depth into each one. Now, this was just a brief overview of ETFs. If you enjoyed this video, please give it a like and a subscribe. That would help out a lot. Only 6% of my viewers are subscribed, so that would be awesome. And I hope you all have a very nice day. Peace.